In a market where headlines swing from euphoria to fear in a single session, two high-profile stocks are making waves, one riding a breakout in the fintech space, the other navigating turbulence in the defense AI sector. Both have captured Wall Street's attention for very different reasons, and the setups could mean opportunity or risk. In this video, we'll break down the catalysts, dig deep into the numbers and the risks so you can decide whether to buy, hold, or lock in profits. But first, to celebrate reaching 1,000 subscribers, we're offering a free guide that explains how top investors identify breakout stocks before the mainstream. Check the link in the description. Remember, this is not financial advice. Always do your own research before making investment decisions, and if you find value here, be sure to like, share, and subscribe so you never miss the next big opportunity. All right, the first stock, BigBear.ai, ticker symbol BBAI. The stock stormed into 2025 riding a wave of momentum, its AI-driven decision intelligence platforms earning high-profile attention from U.S. government agencies and defense contractors. With a specialized focus on national security, the company positioned itself as a niche player in one of the most strategically vital and potentially lucrative corners of the AI market. Early in the year, optimism was high that this positioning could translate into both contract wins and sustained growth. However, the narrative shifted sharply in Q2 2025 when BigBear.ai reported $32.5 million in revenue, an 18% year-over-year decline, and well short of the $40.6 million consensus estimate. Even more concerning was a steep 0.71 cent per share loss, far wider than the expected 0.06 cent loss, prompting management to cut full-year revenue guidance to $125 to $140 million from $160 to $180 million, and withdraw its EBITDA projections entirely. The culprit? Disruptions in key federal contracts, particularly U.S. Army modernization programs. This quarter also exposed one of BigBear.ai's structural vulnerabilities, its heavy reliance on a concentrated set of government programs for the bulk of its revenue. That dependency contributed to a staggering $228.6 million net loss, driven largely by non-cash derivative liabilities and goodwill impairment. On the positive side, the company still sits on a substantial $390.8 million cash reserve, giving it ample runway to invest in acquisitions, ramp up R&D, and pursue strategic expansion. Potential catalysts on the horizon include the proposed $170 billion Homeland Security and $150 billion defense funding bills, which could unlock fresh opportunities in the U.S. market, and a new partnership with the UAE's international holding company aimed at diversifying revenue internationally. Yet the broader AI market dynamics aren't making things easier. While hardware-focused AI stocks are capturing much of Wall Street's enthusiasm, software-centric plays like BigBear.ai are facing heightened scrutiny and pressure to prove they can deliver measurable returns. For BigBear.ai, the road ahead will be defined by execution winning and delivering contracts on time, scaling operations globally, and convincing the market that current headwinds are cyclical, not structural. From a technical standpoint, the stock has pulled back sharply from the $7.5 zone to $5.69, now sitting just above critical support between $4.50. Overhead resistance remains at $6.50 to $7, and a decisive breakout above that range would be necessary to re-establish bullish momentum. A bounce from current support could provide a short-term trade back toward resistance, but a breakdown below $4.50 risks triggering a deeper slide. In the near term, expect elevated volatility. In the medium term, renewed U.S. defense spending and international contract wins could act as key catalysts. Over the long term, the company's significant cash reserves and alignment with national security priorities offer recovery potential if it can prove its ability to translate positioning into tangible, diversified growth. For now, BBAI stands as a hold for high-risk investors, a buy only on confirmed support or a clear trend reversal, and a sell for short-term traders looking to lock in gains until the technical picture improves. The next stock that deserves a place in your portfolio, Celsius Holdings, ticker CELH, with a market cap of $14.46 billion, the stock has emerged as one of the most dynamic names in the functional beverage sector, capitalizing on the global demand for energy drinks and healthier performance beverages. Best known for its Celsius brand, marketed as a fitness drink with thermogenic properties, it appeals strongly to health-conscious consumers and fitness enthusiasts. Partnerships with major distributors like PepsiCo have accelerated its domestic and international expansion, boosting shelf presence in gyms, convenience stores, and major retail chains. This strategy, combined with aggressive marketing and influencer-driven branding, has fueled remarkable returns. Year-to-date, the stock has surged 112.87%, 42% over the past year, and a return of 59.96% over 3 years period. While its valuation is steep compared to legacy players like Monster and Red Bull, the market is pricing in sustained high growth and global reach. Momentum remains strong. Wall Street analysts sees this as a strong buy and deserve a place in your portfolio, though investors should weigh the volatility that comes with high-growth consumer stocks. From a fundamental perspective, Celsius's growth story is backed by strong revenue expansion and widening gross margins as it scales production. The global energy drink market is expected to grow steadily over the next decade, and Celsius's brand differentiation, clean ingredients, zero sugar, and fitness alignment gives it an edge in a crowded category. The company's ability to expand internationally while sustaining double-digit growth rates will be a critical driver for its next phase. Technically, CELH has staged an impressive rally from the low $20s to its current levels around $57, breaking out with strong momentum after a prolonged base-building phase. The stock has clearly reversed its prior downtrend and is now in a strong uptrend, with the decisive break above the $50 resistance zone signaling renewed buying pressure. Immediate support sits near $52, with stronger support around $45, while the next resistance zone lies between $60 to $65 based on past price action highs. The rapid rally has pushed the stock into overbought short-term territory, suggesting a pullback or consolidation could occur before another leg higher. For momentum traders, a buy on a minor dip toward $52 to $54 with a stop below $50 offers a favorable risk to reward, targeting $65 to $75 in the near term. Existing shareholders should continue holding as long as CELH remains above $50, while short-term profit takers may consider trimming positions to lock in gains ahead of potential consolidation. Overall, CELH is best viewed as a hold for current investors and a buy on dips for new entries, though chasing at current highs carries elevated risk. Last stock that deserves a place in your portfolio, SOFI Technologies, ticker symbol SOFI. The stock has evolved into one of Wall Street's most closely watched fintech plays, an all-in-one digital banking platform aiming to redefine consumer finance. With a market cap of $23 to $24 billion, it's far from the scrappy upstart it once was, having surged from single digits last year to trading firmly in the $23 range. Yet investor sentiment remains split on whether it's a buy, hold, or sell. Fundamentally, the company is scaling efficiently, delivering double-digit revenue growth fueled by strong member acquisition, a rapidly expanding deposit base, and improving contribution margins across lending, technology, and financial services, while growing deposits faster than loans to boost net interest margins and reduce reliance on wholesale funding, culminating in a long-awaited turn to profitability earlier this year. Bulls see a diversified revenue model spanning student loan refinancing, personal loans, credit cards, investing, and B2B technology services via Galileo as a moat in a fragmented market, while skeptics worry about sustaining growth in a rising rate environment amid intensifying competition from both traditional banks and fintech rivals. The market outlook is compelling, with SoFi well-positioned at the crossroads of digital banking adoption and embedded finance, scaling its tech platform for third parties while cross-selling financial products to its expanding member base and pursuing an aggressive goal to become a top 10 U.S. financial institution. Still, valuation and risk remain in focus, trading at a forward PE higher than traditional banks but lower than many tech peers. SoFi straddles two worlds, delivering fintech growth with the regulatory demands of a bank, where any lending slowdown, regulatory shift, or margin squeeze could trigger sharp multiple compression after a rally that is already priced in substantial optimism. Technically, SoFi has been in a powerful uptrend, surging from the mid-teens to around $24 and is now consolidating near its recent highs. The breakout above the $21 to $22 zone was significant, showing strong buyer conviction and confirming a shift in momentum. Immediate support lies at $22, with stronger support near $21, the level that previously acted as resistance. Resistance is close at $24 to $25, a zone where the stock has struggled to close decisively above. A clean breakout past $25 with heavy volume could open the door to a move toward $30 to $38 in the short term, while a drop below $21 could trigger a deeper pullback toward $19 to $20. For traders, a buy on a confirmed breakout above $25 offers upside potential, while existing holders should hold as long as SOFI stays above $22 and maintains trend strength. More cautious investors or short-term traders could consider selling partial positions near $25 resistance to lock in gains, especially given the steep run-up and potential for near-term consolidation. Overall, SOFI is a hold for current investors and a buy on breakout or dips, but chasing at current levels without a breakout confirmation carries elevated risk. Let know your take in the comment section below, and if you find value, don't forget to like, share, and subscribe so you will be updated with our latest stock investment opportunity. Thank you.